Good morning and welcome this morning to Trading Flag Patterns, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend, Connie Hill, great educator, phenomenal coach, and 20-plus year veteran, not only of Charles Schwab, but also of the financial markets. So glad to have Connie there answering our specific questions that come up in the discussion. Welcome to all of you. Whether you are here for the first time or whether you are here on a regular basis, it was great to meet some of you at our last live event for the year in Houston this last weekend. And thank you for being there. And I think we had a great time talking about a lot of different things, including flag patterns. And that's what we're going to discuss today as we continue with this discussion. We're going to take a look at a couple of different ways to trade flag patterns. We're going to take a look at a different way to trade a bear flag pattern using a spread with options. And then we're going to look at trading a couple of bull flag patterns, one with stocks and one with a stock plus an option trade. And we'll see how we've got some different varieties. And a couple of quick reminders and housekeeping items that we need to take care of as we jump into this discussion today. As we get started, again, remember, everything we talk about is simply for illustrative and educational purposes only, isn't our recommendation or endorsement of any particular security, pattern, or strategy. Also, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Remember, the spread trading must be done on a margin account. Multiple leg option strategy will involve multiple transaction costs. We're going to use technical analysis. It's theoretical. It doesn't guarantee what's going to happen in the market, but neither does fundamental analysis, neither does probability analysis. They are all theoretical as well. But because of that, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we're going to be using the Thinkorswim desktop software platform, specifically the Paper Money platform today, for educational purposes only. It is not a guarantee future results out there in the real world. However, it's a great sandbox to learn in, so be aware of that. Now, remember that investing involves risk, including the risk of loss. Remember also, speaking of loss, when we talk about stop loss orders and stop limit orders, they don't guarantee the execution price, just the activation price. And so in the event of a stop limit order, there's a potential that the price could gap around that limit area and that order would not get filled. And remember, of course, past performance, no guarantee of future results. So I wanted to talk kind of briefly on a housekeeping note. And that is just that quick reminder that this class, this webcast on Tuesday mornings at 1 o'clock Eastern, is going to be rolled into a broader webcast. That broader webcast is our Trading Price Patterns webcast at 1 o'clock Eastern time on Wednesdays. And so that represents a little bit of a change. We're moving some things around for the new year. We've been talking a little bit about this, but I just wanted to make everybody aware of this as we get started with this discussion. So what I want to do really quickly is I want to pop over here just to the Schwab coaching page. So if you go to schwab.com/coaching, you're going to find this page right here. This is a great resource. But if you click right here on the live webcast page and you scroll down to this list, the calendar for the upcoming webcasts, this is a great place to find new information. If you click on the calendar adjustment, you shift this forward to next year, into January 2025. And then we come down here to Wednesdays. We're going to start picking up here with Wednesday the 8th. Will be dark, of course, on Christmas Day. Will be dark, of course, on Wednesday, New Year's Day. And then the first time we will pick this up is Barb Armstrong talking about trading price patterns on Wednesday the 8th. Coincidentally, that's also the first day that I will be starting to teach this webcast, which is trading index options, which is very similar to what we've been doing in our protective strategies class, but a little bit more of a focus specifically on trading index options. So you're going to see some changes here along the way, but that's where the trading price patterns webcast is going to go. That's where this trading flag patterns is going to get rolled up into. And a great opportunity for us to teach not just flag patterns, because we don't always just see flag patterns, but we do see other patterns as well, and gives us the opportunity to talk a little bit about those along the way. Now, we will keep the same focus on the types of trades that we make. We will keep the focus on trading stocks as well as options. But one of the things that I think is interesting about the way that this trading price patterns class may develop is if we think about kind of the frequency of patterns that occur. It's one of the things that we've always talked about with trading flag patterns, and that is that flag patterns are generally perhaps the more frequent pattern that occurs whenever we have a trend, right? Whenever we have a trend, we typically tend to see flags occur. That's just the way that stocks move. Typically that upward movement, a little bit of a pullback, and then upward movement or downward movement, and then a little bit of a counter trend rally, and then a little bit more downward movement. And so flag patterns, I suspect, will continue to be a big part of the discussion in that trading price patterns webcast. But it also allows us to kind of break things down into other types of patterns that occur. Now, you can probably make the argument, guys, and I hope you've seen this over the last while, that a lot of these flag patterns also could be other types of patterns. And we were talking about, perhaps 2/3 of or 1/3 of a head and shoulders pattern, or an inverted head and shoulders pattern is what a flag pattern becomes, really. We talk about an ascending triangle, and generally an ascending triangle is a longer term flag pattern. So you're going to see flag patterns kind of embedded in a lot of the other things that are in the discussion. Now, in terms of the loss of a webcast, Villager, I wanted to just bring that up. Let me pop over here really quickly, because the other thing that you're going to see is a new addition to the webcast list, and that's this one right here. And I'm not teaching it on the 3rd, so somebody else is going to teach it on the 3rd. It's probably going to be, I'm guessing, perhaps James Boyd, perhaps someone else on the 3rd, because I'm going to be in Dallas teaching another live workshop. We're kicking off right after the first year. But then it's this Market Movers webcast. And the Market Movers webcast is much like what we used to do with the old Wall Street wrap-up webcast. At the end of every week, we kind of have a quick wrap-up. This one, in this case, is 45 minutes long. But it's a wrap-up of what's gone on over the course of the week, and it is a forward look at what's coming in the week ahead. But I think you'll find this one interesting. It's going to be kind of hopefully a little bit more free-form. We're not going to be tied to any particular strategy or idea or account size or anything else. There's more market commentary as well. So it'll be an interesting kind of counterpoint and offset bookend to the Trader Talks series that Kevin Horner does in the mornings. So join me for that one. That's going to add to our webcast list. So I think we've got a net total staying just about the same when it comes to webcasts. So let's do this. Let's jump into the discussion here. And I want to just pop back over here really quickly to our kind of anatomy, if you will, of bull flag. And I wanted to, again, bring this up and kind of reiterate, as we've been talking about these bull flags, one of the things, and bear flags for that matter, one of the things that strikes me is very, very, very rarely does a bull flag look exactly like this? Does it look like that pattern? And so, it's one of those things that you kind of have to train yourself to be a bit more fuzzy in your logic in seeing those patterns. But that's what human beings are really, really good at. And because we're really good at, right, we are very good at doing that kind of soft pattern recognition. And so as you continue to learn and continue to look at trading bull flags or trading flag patterns or trading any price patterns, remember, it doesn't have to be ideal. What has to be ideal, or what should be ideal, is your plan as you get into the trade and as you plan to get out of the trade, right? If this happens, then what do I do? Or if something else happens, then what do I do? And so we've tried to kind of structure this thought process along those lines as we've put all of these trades together. Speaking of that, we've got a feedback survey there in the chat. If you wouldn't mind helping us out, fill out that feedback survey. It's just a couple of quick questions. Connie's going to pin that to the top of the chat. And if you want to click on that and then set that aside and open it up, that's fine too. If you want to click on it at the end of the webcast, you can do that as well. Either way, help us out. Fill out that feedback form. Now let's pop over here to the Thinkorswim platform. Let's kind of see what's going on in this discussion. And taking a look at the S&P 500, we're kind of seeing a little bit of a bearish divergence, maybe a little bit more so than we've seen in the S&P 500 for a little while here. The S&P 500 has kind of been going sideways, right? We've got this up and down kind of piano keys, black and white, or in this case, red and green candle pattern over the course of the last 2 weeks. At the same time, we've seen RSI kind of bleeding off a little bit. We started to see it last week, talked a little bit about it last week. We talked about this kind of moving to the downside, the RSI. And again, we've been operating under this premise that the market has kind of an underlying or inherent bullish bias, and it does. I mean, we can see the overall trend here. The 200 period hasn't budged. It's been almost rock solid. So a bearish divergence like this is oftentimes that this maybe indicates a bit of a pause as opposed to maybe a reversal signal. Kind of sets us up for the idea of bull flags, right? Because we might see momentum wane a little bit and then pick back up. And that's kind of what we've been seeing, right? Rally up, momentum pull back, rally up, momentum pull back, rally up, momentum pull back, rally up, momentum pull back. Same thing, right? More of the same. And each one of these has been a little bit different, but it's had the same net result, right? We've pulled back a little bit and moved higher. I oftentimes refer to this as the Paula Abdul type of trend, right? If you remember her song, Opposites Attract, 2 steps forward, 1 step back, right? Some of you that probably resonates with some of you, not all of you. Connie was a big Paula Abdul fan in her day. Connie had the hair to go along with Paula Abdul. I've got a picture to prove it too. I'm not going to show it, but I do. Anyway, so we see that kind of market movement here going on, and we're kind of in that sideways move. Although, we've had that happen here before, October into November. We had that sideways move. RSI was bleeding off, and then it bounced off the 200 period, or the 50 period in this case, and rallied even higher. NASDAQ, on the other hand, still keeps moving higher. We get this little bit of high speed low drag says who? Yeah, exactly. I knew it. Rally up, pull back, rally up, and it's continuing to move. And we see that the RSI in this particular case continuing to move to the upside as well, seeing that strength, continuing to see that strength. The upside. BJ, I would if I could, but Connie has sworn me to secrecy on the big hair picture. But all right. Now we shift over to the Russell 2000 and the small caps. And the small caps have kind of made an interesting pattern here, right? So we had this rally up and into a little bit of a cobra. Pat Maloney and I used to call this a cobra pattern, right? Big move, kind of that impulse move to the upside, and then a very short, very obtuse symmetrical triangle. It's a flag, and oftentimes it moves in the direction of the prevailing trend. The last 2 times that the Russell 2000 has come up with this cobra pattern, right, where it's squeezed into this little pattern, it's broken out to the downside. And we've seen kind of this pullback in momentum in both cases, and we're seeing the same thing here. Now we see a little bit of a bear flag in the Russell 2000 itself, right? And we see this rally up and then the pullback and then that sell-off. Now, we're right at the 50 period moving average where it's bounced once, twice, three times, potentially a support level here. It's also, though, come down to the 200 period moving average. So there's a possibility. We're starting to see that greater disparity between the 50 and the 200 here. The 200 maybe slowing a little bit, even though the 50 has been accelerating a little bit. We see the RSI breaking that trend line and, in fact, just at some recent lows. So I would argue, if I were looking and searching for bear flags, this type of pattern setting itself here up on the Russell 2000 might suggest that bear flags might live more readily and more abundantly within the Russell 2000, or at least in the small caps in general, than they do in the NASDAQ or in the S&P 500. And I think we're probably likely to see that type of scenario. In fact, the examples that I've got kind of come and have fallen along exactly those lines. So let's take a look at the first example here they wanted to bring up. And this is that bear flag, and this is MongoDB. It is in the small caps. Small caps, if you remember when they reconstituted the Russell 2000 as they do every June, added about 13% more technology stocks because of the composition of the market overall. MongoDB, one of those technology stocks that got wrapped up into the small caps at that point, into the Russell 2000 index, and now perhaps giving us a little bit of a bear flag. So let's pop this over here into the chart. I'm going to go to our single grid chart here. This is the playground and sandbox that we use to kind of explore these ideas. So this is MongoDB. And you can see that overall its trend has been somewhat down, right? We've had this peak up here, this high up here in the 503 range. It's pulled back. It's rallied back up. We've kind of had this broader pattern. And then most recently, post the earnings announcement, we had a gap down and a sell-off, big momentum candle, a little bit of a rally back up. So again, another short bear flag, and then a sell-off with a couple of big momentum candles. Now we're kind of seeing the same thing happening here, right? So we're seeing this rally up off this hammer-like candle or inverted hammer-like candle. We get a little bit of price change or kind of directional change here coming from that candle. We see the RSI weakening, continuing to weaken here a little bit. And then that tosses out this little doji star. Now, if the overall trend coming into this were maybe a little bit more bullish, right? If the longer term trend were overall more bullish, we might be looking at this type of pattern as what we might call a morning star type of pattern, where we get a big momentum candle, then we get kind of an equilibrium candle, but not really. And then we get a move back to the upside. And that's kind of the dawn, if you will, the new uptrend. But in this particular case, I don't know that that's really what's going on here, especially with that RSI bleeding off a little bit. That suggests to me that maybe this becomes a bit more of a downside move. So remember, if our entry into a bull flag comes as a function of a close above or a trade above the high of the low day, right? Hold. Then oftentimes our entry into a bearish trade becomes a kabloat or a close below the low of the high day. So if this is our flagpole to the downside, and then this is our rally back up, that's our pullback, if you will, in the direction of the trend, and then we see this move in the opposite direction. So what we're looking for, if this is the high day in this pattern, close below the low of the high day, that would mean that our low in this particular case, let's look at the information up here. So I'm going to go here to put on my cursor on that candle. Our low is 260.30. That's going to be right here, right? So what I'm going to do is I'm just going to draw a line right at that 260.30 range. We're just going to call it right there. That's the line that we need this to move below for an entry into this particular trade. And the reason for that is that's going to give us confirmation the price is continuing to move to the downside. So I'm going to zoom back out a little bit here. And I'm going to look at this in a couple of different ways. One, if we were trading this as a stock, right? if we were just trading the stock. We could short the stock. Now, remember, shorting has to be done in a margin account. There are certain circumstances that have to exist in order to be able to borrow the stock, to be able to short it and take advantage of that downward movement. Okay. The other thing that we could do is we could buy a directional put, right? And buying the put option is going to be the most directionally sensitive type of trade, aside from shorting the stock. But buying the put option requires that the stock is going to have to move faster than time decay, right? So we also have to factor in what implied volatility is doing, and it's very likely that implied volatility may be reasonably low following that earnings announcement, but at the same time, the stock's probably been going, that implied volatility has likely been going up because the price of the stock has been coming down. So these options have been becoming more and more expensive. So that might be detrimental to the buyer of a put option, making those put options a little bit more expensive. The next thing I want to do here in this discussion is kind of put a target to this, right? The expectation of where it might go if we were seeing that move to the downside. Now, here's the thing. I could use this point right here. I could use this high point right here as the kind of base of the flagpole. The reason I'm not going to do that, and oftentimes I might exclude a big move like that, is because of this earnings announcement, because I'm not likely, in the length of time that I expect to be in this particular trade, I'm not likely to see another earnings announcement come around. So I'm going to exclude that kind of earnings-driven big move to the upside or big gap to the downside out of the discussion. So in fact, what I'm going to do is I'm going to assume that there's a level of support, which is now potentially resistance, right here at about that 332 mark. And so this becomes then my flagpole portion of the trade. And if I were to just draw that line from the top of that, what is now resistance, what was support that got broken through, and I duplicate this line, we right click and we duplicate it. And then let's grab that. Before we grab that, what I'm going to do is I'm going to just zoom back out a little bit. I'm going to grab that line. So I'm going to just go activate now that I've grabbed that once. There we go. And we'll just put it right down here. And that would suggest that our target is going to be somewhere at that support level or below. In fact, if we were to squeeze this down, that would suggest that our target maybe is somewhere right down around that 200 even mark. Now, I'll tell you what, this level of support that exists here at 213 has been tested once. It's been tested twice. If we were to go back in time and look further left, I would argue that we're probably likely to see this whole area be here between about 213, 214, and 200 acting as a level of support. Because remember, we draw levels of support and resistance with big fat magic markers. So what I'm going to look for, and now I can zoom in a little more closely on this price, is I'm going to look for 213 or 214 to be the target to the downside. And I'm going to look for the threshold to get into the trade being right here at about that 260 mark, breaking down through that 260 mark. So you know what I'm going to do in this particular case? I can look at putting this trade on one of three ways. Well, there's many ways we could do it, but one of three ways. One would be shorting the stock, and we talked about the requirements and risks and necessities for doing that, right? Because one of the risks of shorting the stock is the stock starts to go higher, and there's no upward bound on the price of the stock going up. And so that's theoretically undefined risk on the part of that short position. And you may have to add money if you get into the position of being in a margin call and the stock continues to go higher. So we can short the stock, but again, that's going to require a margin account. We have to be able to borrow the stock and so forth. We could buy a put option and take advantage of that downside movement and buy that put option if the price of the stock were to break that 260. So let's do that first, and then let's do the second way. Add this trade. So I'm going to go to the trade tab, and I'm going to go out a little bit of time. I'm going to give it enough time to make that move to the downside. And we'll make this a contingent order to enter this particular trade. So what I'm going to do is I'm going to go to the 31 Jan expiration. And you're right, it probably did bounce a couple of times right there at about the 250 mark or so, 260, down around that range. We had some support in that area. So let's go back to that trade tab. I'm going to go out about 45 days worth of time, 31 Jan expiration, and I'm going to look at buying a put option. Now, generally buying a put option, like we talked about earlier this weekend in the option strategies webcast, and Connie talks about this, right? And that's the other reason, Ricebird, that we might not short that stock, because it typically cannot be done in an IRA account or a registered account or a limited or a tax deferred account like that. But this is something that Connie talks about in her long options class, is thinking about when buying a long option, in this case, buying a long put, buying that long put that has some intrinsic value, meaning buying an option that is a little bit in the money. So in this particular case, I'm going to go, you could, Rob, I mean, you could take that opposite side. You could say, if price bounces off that support and goes up, then get long the stock and put a stop below it, sure, and take advantage of that upward movement. And at the same time, you could have an OCO order that says, if price goes down, then enter this trade, right? And you could put on a kind of mental conditional or even a conditional order that way. So in this particular case, I'm going to go to an option. In this case, the stock's currently trading at 266. I'm going to look at buying the 275 put option. It's going to be slightly in the money. It's going to have a delta of about 54 cents. So it's going to be a little bit more directionally sensitive. It's going to be less cost and less buying power impact than shorting the stock. Right? It's not going to be cheap because it's a $400 stock. So if I were to buy that put option in this particular case, again, remember, this is taking advantage of downward price movement. The maximum profit would only be achieved if the price of the stock were to go below or to zero by the 31st of January. And that's probably not a likely scenario. But at the same time, we're looking at taking the trade off if the price of the stock gets to a particular level. So what we're going to do, I'm going to put this in our trading flag patterns group. But instead of just entering this trade right here, you know what I'm going to do is I'm going to do this. I'm going to go back to the edit orders. And I'm going to actually make this a first triggers sequential. Okay, so let's go to single order. We'll make that first trigger sequential. And then I'm going to do this. I'm going to right click and I'm going to create an opposite order. And that opposite order is to sell the put option, right? Buy it if it does what I expect it to do. Sell it if it does what I expect it to do. But here's where I'm going to use this little conditional gear icon over here. And Connie, I know, has taught a couple of webcasts on this and on a couple of occasions on putting these types of orders together. So we know that we want to get in if the price of the stock itself, the underlying stock, breaks that high or that low of the high day, which we said was at, what did we say, 260.30, I think it was. Let's do that. Let's go out and look first, just to make sure. The low of the high day is 260.30. I was right. Okay. So we're going to go back to our trade tab. And let's bring that trade back up. Go to our gear icon. Let's go to our gear icon. And let's bring in our conditional order rules. Now, we're going to make this a market order because we don't know what the option is going to be priced at this point. We're going to say when MDB marks at or below 260.30, 260.30, then enter the trade. Okay. We're going to click on save. Now we've got a conditional on that entry order, getting into the long put. Okay. Now we're going to make this second order, which is a sequential, which only becomes a working order if the first one fills. Okay. If the first one fills, we're also going to click on that conditional gear icon there, and we're going to bring this order up, and we're going to make this a market order because we don't know what the option is going to be priced at if the price of the stock goes down. And we said that we're gonna get out. Let me just make sure that we knew where our target was again here. Squish that up, and our target here was at 215. We'll call it 215. So let's go to that gear icon again. Let's bring up our conditionals. We're going to make that price rule a market order, and we're going to say good till canceled. And if MDB marks at or below, in this particular case, 215.30, or yeah, 215.30, I think it was. We'll just call it 215.30, give it a little bit of room. And then we'll click on enter, and we'll click on, whoops, I didn't do it. It didn't, for some reason, it didn't fill that 230. It just did a 0. So we don't want that. We want to make sure that that actually, in fact, when we overtype it, 215.30, there we go. Now it entered. So if MDB marks at or below 215.30, then exit this option trade. And now we can click on save. And what we've built here is a conditional order that gets us in if we get the close below the low of the high day, and gets us out at the target. And we're going to go ahead and we're going to click on confirm and send. We're going to read through this order, make sure that that's what we want. We're going to click on trading flag patterns. That's the group we're going to put it into. And we know what our triggers are. If the price of the stock moves below 260.30, then get into the trade. And if it moves below 215.30, get out of the trade, close it down. And that's going to be good till canceled. This one's going to be a day order. And we're going to go ahead and click on send and fire that order off. And it's sitting there waiting. Now, the other thing that we could do in this particular case, and by the way, thank you, Connie, for reminding everyone to subscribe to the Trader Talks webcasts channel. Click on that little subscribe button down at the bottom of the page, and that's going to link you up with that subscription. It's at no cost to you. Now, the other thing that we could do is we could trade this as a long put vertical, right? And the expectation being that this put vertical becomes in the money because of the movement of the price of the stock. So once again, we know where our entry is. It's going to be 260. We know where our exit is going to be. It's right around the 215. So we're going to structure the trade that way. So what I'm going to do is I'm going to come down here to the trade tab. And we're going to build this as a long put vertical spread. Okay. And we're going to see what this looks like. So we're going to go over here, and I'm going to go a little bit shorter term on this one because I'm kind of looking for liquidity here. So I'm going to go to the 17 Jan expiration. And I'm seeing some pretty good tighter bid-ask spreads in this particular case. So I know that I want the stock to go at least to 215, right? Maybe even a little bit beyond. I don't have a 215 strike. I've got a 220 and a 210. So maybe what I want to do is I want to look a little bit shorter. Let's see if I've got, there we go. Now we've got a 215, but not a lot of liquidity there. So let's go shorter. Let's go to the 10 Jan and see if we've got a 215, and I don't have much liquidity there either. So that means, because those haven't been trading very much, I'm going to go to the monthlies and we'll see if we've got some liquidity right in that range. So what I'm going to do is I'm going to look for this stock to move down, and I'm going to kind of get it close. I'm going to look at the 220 strike. So we're going to sell the 220 strike. That's going to be our short strike level. And I'm going to start at that point, but that's not going to be the driver of the trade. The driver of the trade is going to be what we're looking for this to move, to really kind of move this down to the downside. But I want that to be kind of my target. I want both of these to end up in the money. And if we're expecting the stock to go down to 215, starting right there at about the 220 level is okay. I'm going to sell that 220 put. And then at the same time, I'm holding my control key down. I'm going to come down here and I'm going to buy in this particular case, because I still have that expectation that this is going to go down. It's trading at 266. I'm going to buy the 260 put. Actually, you know what? I'm even going to buy a little bit further out of the money. I'm going to buy the 250 put. So we're going to have a 250, 220 long put vertical spread. By the way, if you want to learn more about this trade and about this type of vertical spread, I teach on Thursdays, and will continue to teach on Thursdays, long vertical spreads. And in that particular webcast, we talk about putting these types of trades together. But my expectation in this trade is that the price of the stock is going to move down below or to 220, and these are going to end up in the money at expiration. And so we're going to go ahead and we're going to click on confirm and send. We're going to read through this order. Now our maximum loss is significantly less than it is in the long put. Maximum gain is less as well, but we're defining our risk, and I'm going to put that in our trading flag patterns as well. All right, we're going to go ahead and click on send. Now and that one filled right away, and so that order is in place. Now here's the other order, the other trade that we're going to look at. I'm going to go back over here and bring up my scratch pad, and it was this one. It was the United Airlines. So I'm going to come back over here to the United Airlines one, and I'm going to go to charts. We'll just bring up UAL. And we've used this as an example in a number of cases here. And what I happen to notice is that we're also getting that RSI move to the downside, kind of a little bit of that pause, but we're also seeing maybe a little bit more defined kind of bounce characteristics here. So rally up, pull back, and maybe a little bit of a bounce. Now, if I'm going to ask myself the question: is this a stock that I really truly want to buy, right? And so we might look at that and say, yeah, it's in an uptrend. Maybe the fundamentals meet what I want it to do. So I'm okay buying the stock, but I want to do a little bit better, and I want to, yeah, and Naresh, yeah, absolutely. That's one of the things that you might do is fundamental discussions. Same thing here. We might look at the fundamentals for United Airlines and say this is a stock that I feel comfortable buying. So what I want to do, though, is I don't want to hold on to the stock necessarily. I want to buy it and I want to sell it, just like we might put a stop order in if the price of the stock goes up to this previous resistance, maybe that first flag target. So rather than buying the stock here and then putting in a stop order to sell it, I think we can do a little bit better. What we're going to do is we're going to create a covered call. So what I'm going to do is I'm going to do this in one fell swoop. Okay, I'm going to create that order. Now remember, the obligation that we create when we sell a covered call is we create an obligation to deliver the shares of stock at the strike price. So if my target is up here right around 104, I'm going to be looking for like a 105 strike price. So we're going to go to the trade tab. And I'm going to look out here in time a little bit. I'm going to go out maybe to the 24 Jan, and I'm going to look for option liquidity here. And I've got pretty narrow bid-ask spreads. These are pretty liquid stocks. And I'm going to look out here at about that 105 strike price. That's right down here. That 105 strike price is going to bring in about $3 worth of premium. So what I'm going to do is I'm now going to change this layout from spread to covered stock. And so now the order the price that's being quoted here in this bid and the ask is the price for buying the stock and selling the call option at the same time. So if I go after the 105 strike, this price right here, the 92.47, is the net cost of buying the stock right now at 95.15 minus the $3 roughly of premium that I'm bringing in for selling the put up or the call option. So I'm creating a buy right covered call. My expectation in this case is that I get called out of the stock, right? The stock gets called away from me. And it's as if I'm putting in a stop order or a limit order to sell the stock if the stock goes up to that 105 target. But I'm just doing it and I'm capitalizing on the ability to bring in some premium here. So we're using a covered call strategy to trade this bull flag. And I'm going to buy the stock, sell the call option at the same time, and create that obligation. Now, if the price of the stock goes down, that's going against me, right? Same as if I had just bought the stock and put in a limit order. If the price of the stock goes up and goes through this call option, then at expiration, if we let it go that far, then that stock's going to be called away from me if it's above that strike price. If at expiration, though, the price of the stock is below the strike price that we sold, then we keep the stock and we have the opportunity to sell the call option again, theoretically. Okay. So what I'm going to do is I'm going to confirm and send. I'm going to put this in my trading flag patterns group, and I'm bringing in a little bit more premium, and that's going to maybe essentially create the situation where I'm buying the stock at a little bit of a discount to where it's currently trading, and expect that the stock is going to go up to where we would set the target anyway. And I'm going to go ahead and send, and we'll fire that order off, buy the stock, and sell the call option at the same time. And there it goes. All right. Now, Shiva's question on the previous trade, the long put, the one on Mondo, on MDB. When would I close that out if the stock goes in the opposite direction. So let's go back to that really quickly here and just kind of review that, MDB. And the idea was, okay, we've got that order waiting. It's sitting there waiting to go. And so the idea is, when would we close this trade if we were to get in and it goes against us? And the idea might be we might get out of that trade if it comes back up through one of these resistance levels. But since we're creating this as an option order, we've already got a defined maximum theoretical loss in that trade, right? So if it goes up, then we're going to be losing on that option. So here's the other thing we might do with this trade. So let's go back to our working order here. Go back to our monitor tab. Let's go to our working order. And here's our order to get into MDB. So let's do this. Let's also go right click, cancel replace. Or in this particular, let's do cancel replace. And what we're going to do is we would then make that also, we could make this an OCO, first triggers OCO, and we would create another opposite order, and we would trigger that opposite order the same way. We would just say, make this a market order, make this good till canceled, and we would trigger if MondoDB went above, we said 275, right? So 275 might be our exit threshold. We don't know what the option is going to be trading at, but we're basing this on the movement of the underlying stock, 275, and then we would click on save, and then we would fire that order off. And now what we've done is we've created that as an OCO order. So if it goes up and the opposite direction we want it to go, we get out. If it goes down the direction we want it to go, we get out, right? But that's triggered by where the underlying stock is and not by the price of the option itself. So good question. Great question to ask. And position size based on the premium. Yeah, we would base that around that maximum theoretical loss in the trade. So hopefully that cleared that up and helped that clarify that discussion. So let's pop back over here again really quickly. Now remember, again, those changes that are coming up, if you come back up here to the live webcast calendar, or if you go to here to Trader Talks webcasts, this is where you're going to find flag patterns. And you can pop that in here and you're going to see all of those flag patterns. And this is also where you might see, like we talked about, long vertical spreads. Or long options, which Connie teaches, but here's where you're going to find long vertical spreads. All right, guys. So again, my thanks to Connie Hill for helping out. My thanks to our great production staff. We've got that survey in here, that feedback survey. So if you wouldn't mind filling that out, letting us know what you think and how we can make these sessions better. And remember, we're going to be shifting this next time that that this will be taught will be January 8th. And that'll be Barb teaching breakout patterns. So it'll be, or trading price patterns. So it'll all be wrapped together. Again, my thanks to Connie and thanks to all of you and to our great production staff. Have a great day, everybody. We'll see you again very soon. Happy holidays. Bye-bye.